In this lesson, we're going to talk about flexible budgets and standard cost. Just a quick reminder of what happens in a budget. Again, a budget is a plan. So you develop this plan, usually looking at your objectives, your future goals. You then compare that plan to your actual, and you try to figure out where the differences are. So if I plan to spend, $100,000 on advertising, and I actually spent $105,000 on advertising. Why did I spend $5,000 more? You then take corrective actions, or maybe strategic actions about that $5,000. Do I need to just increase the budget? Is it going to cost me $105,000 from now on, or was it just a one-time event? Is this an area where maybe I should be cutting costs? Did it actually make sense to spend that much money? And then you move over and you revise your objectives and prepare the new budget. And that's exactly what you would do. So you would revise that plan. And it just keeps going around in this circle. It makes this cycle. Management obviously uses budgets to monitor and control operations. We've talked about this. Managerial accounting is all about planning and control. So this is what you've learned about budgets already. Now, obviously, this isn't a master budget. Let me just kind of stop it from doing that for a second. This isn't a master budget. Master budgets are huge when you get into the cash budget and all of those things. But really, up to this point, even in the master budget, you've determined how to do a fixed budget. Basically, we think we're going to have this many unit sales at this price. Therefore, we have to buy this much in materials. We have to spend this much in labor. We have to apply this much overhead. And that's it. Right? So that's what a fixed budget is all about. This is a very, very simplified version of that same fixed budget. We see that we plan to sell 10,000 units. That's going to give us $100,000 in sales. That's going to cost us $49,000 in cost of goods sold, $13,000 selling, $26,000 general, and our income, if we sell 10,000 units, is going to be $12,000. That's the planning piece. Now you need to compare it to your actual results. Well, it looks like we actually sold 12,000, and that resulted in income of 125,000, and these related expenses to give us 25,400. Where the system was going to explain these to you is that you may have an unfavorable variance if the actual cost. I wish it would just kind of stick around. Let me leave it there for just 1 second. So an unfavorable variance would be if you have higher expenses, right? If you spend more than you planned, that's unfavorable, right? Spend more than planned, that's unfavorable. However, in sales, obviously, if you made more than you planned, that would be favorable, right? If these variances down here were negative, they would be favorable as well because you would have spent less than you planned. I think you get that, right? I don't want to belabor the point too much, but let me just point out a couple things to you here. So we see that this is a $2,000 change, right? There's no question about that, or not a $2,000, 2,000 unit change. Why wouldn't this be 120,000? Why is it 125,000? It feels like something's wrong here. Without a doubt. I mean, we're only selling them for, what, $10 a unit, right? Because we're only adding 1 zero in. So we sell each unit for $10 a unit. If I increased by 2,000 unit sales, wouldn't this have only been a $20,000 variance? Why is there 5,000? And the point I'm trying to make is that there's something else going on other than the fact that you sold 2,000 more units. Something else has happened that we don't really see immediately. I see it because it's the kind of stuff I do. It's what I look for. But the reader doesn't. They just say, oh, wow, great, we did $25,000 more in sales. That's wonderful. But I still beg the question, why is it 5,000 over? Why is it truly 5,000 over, not 20,000 over? The same thing could be said here. If we're selling 10,000 units, and cost of goods sold is $49,000. That's $4.90 per unit. Well, 2,000 times $4.90 per unit does not give you a $9,100 difference. It gives you something other than that if you did the math. So there's some other stuff going on that we just don't readily see here. And that's why a fixed budget is not necessarily the best budget to really help us to identify what these variances are. Because step 3 in the budgeting process is to identify what these variances are and then take action based on the results of that identification. Am I just selling more at a better price? Is this really going to cost me more? Is this a true new number, or can I cut costs here? We really can't answer that question because we've got some stuff hidden here. So we want to move into the flexible budget to see what happens there. Got to get rid of those again. All right, so a flexible budget helps us show revenue and expenses that should have occurred at any actual level of activity. Okay, well, you'll see that in a second, but what that means is that if I had a fixed budget for 10,000 and an actual for 12, there's a 2,000 quantity difference that's already going to create a problem. How can I just get rid of that 2,000 quantity difference so that I can align things more appropriately? It can be prepared for any activity level in the relevant range. There's that term again. Remember the stepwise cost? We have to stay within a certain range, otherwise fixed costs start to change. It reveals variances due to good cost control or a lack of cost control. That's good because that'll probably help us do our job, and it helps us to improve performance evaluation. So let's look at what happens in a flexible budget. In order to do this, we need to understand once again how costs behave. It's very important that we understand the difference between variable and fixed cost. Remember that variable is going to go up in proportion to changes in activity, most likely sales, and fixed costs will remain unchanged within any relevant range. All right, so what happens when we flex a budget is that we want to get things down into their unit cost level if we can. Now remember, in order to get to a unit cost level, we really need to change from an income statement standpoint, meaning sales and cost of goods sold, down to a contribution margin type income statement in which we can split our variable cost out from our fixed cost. And you'll see that's what we've done. This is the exact same data. It's $10 per unit in sales. Total variable costs are $4.80. Don't get confused by my last statement about cost of goods sold being $4.90. If you go back to that slide, and you see cost of goods sold were $49,000 when we sold 10,000 units, so $490 still holds true. But remember that in a variable cost income statement, we have all variable cost in here, which was going to include any selling and administrative expenses and take away any fixed portion that might have been a part of cost of goods sold. So some changes have been made here. In any case, we've moved this to a contribution margin type income statement. Fixed costs still do not change within the relevant range. We have to bring them down in whole. Okay, so here's my flexible budget data, and look at what happens. This is exactly the same as we had it on the previous slide. If we're selling 10,000 units, our income from operations is $12,000. If you don't believe me, back up and look, but it's exactly the same. It's $12,000. What happens here is we can say now that with a flexible budget is what would the budget look like if we sold 12,000? What would the budget look like if we sold 14,000? Because now we can just multiply this out. 10 times 12,000 is 120,000. Do you remember what it was on the fixed budget report when we sold 12,000 units? It wasn't 120,000, right? And I'd mentioned, I was like, something else is wrong. Variable cost is 480 times 12,000 units for 57,600. So basically what the flexible budget shows us is what net income should be if we sell 12,000, if we sell 14,000. Could you do a flexible budget on, I don't know, 13,532? Absolutely. You could put 13,532 in here and carry the math over and see exactly what your budget should look like if you sold $13,532 or 32 units. Now that we have this type of information, we can compare our flexible budget to our actual. So here it is. Here's the flexible budget performance report. Here's what our budget would look like for 12,000 units. And here's that same actual that we had from the prior screen, but now in a contribution margin format. See this? We no longer have a $25,000 variance. We have a $5,000 variance. And it's because we have 5,000 that's unexplained. Okay? Here in variable cost, we've got an $1,800 unfavorable variance. We have a $200 unfavorable variance in fixed cost. We've really whittled this way down. We've brought it down to something that's a bit more manageable and that we can really focus on. We don't just have to take out the quantity variance anymore. We can just deal with what we perceive to be wrong. Okay. Yes, we know what favorable and unfavorable is at this point. All right. So, in order to do flexible budgets, any budget really, we need to understand that we are going to use standard cost. In order to get down to that unit level that we need to do a variable cost contribution margin statement, we have to understand what standard costs are. We use standard costs in flexible budgeting to help us understand the reasons for the variances. If we don't have this, if we don't know what our budgeted costs are, then we can't understand what the variances are. And don't mix up terminology. Standard costs really are, again, just estimates. They in themselves are budgets, but they're budgets at the unit price level. So obviously they're going to be based on predetermined amounts, carefully predetermined amounts. Very important. We don't want to just pull stuff out of thin air. We use them for planning materials, labor, and overhead requirements because we deal primarily with production based on the expected level of performance, and they are our benchmarks for measuring performance as well. It takes a lot of people to do this. I mean, 4 is not a lot, but in bigger organizations it's going to be a lot more than 4. But you'll see that these 4 people, as a sampling of the ones who bring this together, are all from different areas of the organization. We have the engineer, the production manager, human resources, the managerial accountant. These people need to come together to set these standard costs and to do it realistically. I'm going to tell you right now that in the real world, these 4 people usually don't get along very well. They are very different personality types. They do very different things, and they all typically seem to have their own agendas to some degree. Well, with the exception of the managerial accountant, because they're the most level-headed people in the organization, right? They should at least be the most unbiased people in the organization, without a doubt. But these people usually fight a lot. I'm just going to tell you, in the real world, if you get on one of these committees where you're going to set standard costs, I hope you can handle confrontation, because you're going to see a little bit in there. These people need to set practical standards. They have to be set at levels that are attainable with a reasonable and efficient effort, because if we get too ideal, right? Ideal standards are going to be based on perfection. They're not attainable, and really it's just going to bring down morale. Anytime anyone sits down to do a budget, folks, I'm going to tell you right now, everybody wants to live in an ideal world where they can make the most money and their product is going to sell for the highest amount possible, and they're going to be able to spend as little as possible to make that net income. People really like to be very ideal when they set their budgets, and it's usually just not even possible. And all that does is it brings the people that have to rely on that budget as a guideline, it brings them down because they just can't reach that goal. All right, so I'm going to go ahead and warn you a little bit here now, because a few of the slides that you're going to see in here just are going to be, it seems like gibberish. The publisher kind of went to great lengths to turn some of this kind of upside down and use variable type acronyms to help you identify price and quantity standards, or price and quantity variances. Sorry, I have a hard time talking this morning. But really, it's not as hard as they want to make it. I'm going to tell you right now, just kind of give you a head start, is that all of this over here has to do with money. Price, rate, has to do with money. This over here has to do with quantity, right? Quantity, time, and activity, all of these things are quantities, without a doubt. This might be each, and this might be hours, and this might be per direct labor hour. This might be $2, this might be $12, this might be $8. But no matter what, it's just they're using different terminology for the different types of product cost that we're going to relate to. But at the end of the day, this is dollars and this is units over here. So let's go ahead and just try to focus on that for a second as we get a little bit farther into this. So we have to set standard costs for direct material, direct labor, and for overhead. We're going to be using ProBat as our example, and we're going to look at the standard cost card for creating one bat, right? The cost of creating one bat, not the price that we're setting, but the cost that it takes to create it. And we need to break it down into its unit pieces. So it looks like it's going to take 1 kilogram of wood at $25 per kilogram. That's a $25 cost. 2 hours of direct labor, I guess, to turn it at $20 per hour. We have some skilled labor there. That's $40. And then our overhead is based on labor hours at $10 per hour. So we have $20. So it's going to cost us, this is our estimate, this is our budget, this is our standard cost to create one bat in our production facility. It's going to cost us $85. All right. So these standard cost amounts we use to prepare our manufacturing budget for whatever production level. So when we start talking about cost variances, the standard cost variance is the amount at which actual cost differs from standard cost. If our standard cost is here and our actual is up here, it's unfavorable. This is right on target, and this is going to be, well, this one's kind of weird because you would think this would be favorable, but we're going to have to just think a little bit about that as we approach it. Just said about all that. All right. So variance analysis involves preparing standard cost performance report. Absolutely. So we prepare reports. What are we doing when we prepare reports? If you go back a few slides, we're looking at the budget versus the actual to give us the variance. Then some people come together and they start to analyze those variances. What was the problem? Who made a mistake? What's wrong? Can we fix it? It goes into a Q&A time to try to figure it out. And then this is where we take action, whether it's strategic or corrective. Just worked all of that out. All right, so our cost variance computation, and this is where it kind of gets a little bit crazy, and I'm going to tell you that you can probably figure this out on your own without the publisher getting to this. Cost variance is CV, actual cost is AC, and standard cost is SC. I think that just confuses people, but let's really look at what this is. You know what a variance is at this point, right? It's the difference. It's the difference between the budgeted and the actual. Okay, so they're saying that the difference equals the actual cost minus the standard cost. This is our budget. Difference equals actual minus budget. Okay, that's what variances are. So we get that. We don't have to go too crazy with that. And then this starts to explain a little bit more, and this again is where it goes a little crazy. They say, okay, well, let's define actual cost. Okay, well, actual cost is the number that you actually bought times the price that you actually paid. I think we get that. And the standard cost, which I like to call the budgeted cost, is the quantity that we budgeted times the price that we budgeted. Okay, I don't know that we needed that explained, but what the publisher is trying to do is to get you to follow him down this rabbit hole to understanding what all of these variables are, and I say ignore them. We just don't need to go that crazy with it. All right, so cost variance computation. So we need to figure out, right, the reason that we're analyzing variances is because we want to tell the people who are interested in why there's a difference, what the differences are about. There's only two things that can create a difference. There's only two things that can create this difference or this variance. Either we paid too much or little, that's the price variance, or we bought too many or too few. That's the quantity variance. So those are the only two things that can create a variance. Either the price was wrong, the price was different than what we budgeted, or the quantity was different than what we budgeted. And actually, I'll change that to say either the price was different from what we budgeted and or the quantity was different from what we budgeted, because it can be a little bit of both. It can be price and quantity without a doubt. All right, so let's see if we can take a look at this model. So what happens here is that we need to try to figure out, is it a price variance problem or is it a quantity variance problem? And how do we figure which one it is? So if it's a price variance problem, you'll see that all we have to look at is, was the actual price different from the standard price? That's it, right? Was the price different? And if it was, we're going to multiply that difference that sits in here by the actual quantity. Okay, so to find the price variance, we take the actual quantity purchased times the difference between the actual price and the standard price. That's, to me, I think that's just the better way to view it. If we're looking for the quantity variance, did we have a quantity problem? You'll see that we had a difference between what we actually purchased and what the budgeted quantity was. That makes sense, right? We understand that. How do we find the variance or the difference? We take the difference between the actual and the standard quantity and we multiply it by the budgeted price. That's it. I mean, I think that's a whole different write-up than what this looks like, because I think this is really, really confusing, right? To find the price variance, we take the actual quantity times the difference in the price. If we want the quantity variance, we take the difference in quantity times the standard price. That's it. All right. So again, the cost variance computation, this is where the publisher went crazy and said, let's use it as variables, AP minus SP times AQ. Forget it. Don't do it. It's not worth trying to keep that junk in your head, man. It's just, you know, we can think about words. We don't have to think about acronyms for this kind of class at all. All right, so computing material and labor variances. Let's get into the examples, because there's nothing like practice that'll help you get this done without a doubt. So we're still talking about GMAX. No, we didn't talk about, we were talking about ProBat earlier. Now we're talking about GMAX, so we're going to switch the example around altogether. GMAX makes golf club heads with the following standard cost information. For direct materials, it looks like it takes about a half a pound per golf head at $20 per pound. Therefore, each golf head costs us $10 in direct material. It takes 1 hour of direct labor at $8 per hour, so $8 for labor, and that gives us our total standard direct cost per unit of $18. What are we missing? We got to be missing something here, right? We're missing our overhead. Don't remember that all of our product costs are direct material, direct labor, and overhead. So this is just the completely variable piece. The 10 and the 18 gives us direct material and direct labor for one golf club head, 18 bucks. All right, so during GMAX, we're just going to work out the material and the labor piece of it. During May, GMAX produced 3,500 club heads using 1,800 pounds of material. GMAX paid $21 per pound for the material. Do you already see a problem? I mean, I already see a problem, right? We should have only paid $20 per pound. That's the easiest one to pick up. It looks like we have a price variance already of $1 per pound, without a doubt. And then we're looking and it says that we produced 3,500 club heads. Well, 3,500 club heads at a half a pound per club head does not equal 1,800 pounds of material, right? It just doesn't. So we've got not only a price variance, but we've also got a quantity variance. Let's see what we can do to figure that out. So here we go. It was supposed to be $20 per pound, not 21. So we have a $1 price variance, and again we're going to multiply that by the actual quantity of 1,800 pounds. So there's a $1 difference, 1,800 pounds. What about on the quantity variance side of things? Our problem is going to end up being this 50 pounds, and we would take that by $20 per pound. So here's how it comes out. Remember, I said $1 times 1,800, there's our price variance. Is it favorable or unfavorable? I don't know, you tell me. I was only supposed to spend $36,000, or I should have only spent $36,000 based on $20, and I spent $37,800. I spent more than I should. That's unfavorable, right? That's the easiest way to look at it. What about over here? It looks like I should have spent 35,000, but I actually spent 36,000. I would have spent 36,000 if I had the right per pound, and that's unfavorable, right? So if I add these two things together, I've got a $2,800 unfavorable variance, and the reason is because I had an $1,800 price problem and I had a $1,000 quantity problem. Okay, so now I can really go to the table, to the powers that be, and they can say, oh my gosh, why do we have a $2,800 problem? I say, somebody spent too much money and somebody bought too many. And then we try to talk it through. And somebody might say, yeah, we had to rush ship it for some reason. We had to pay an extra dollar per pound because it was a rush order. Okay, we get that. Is it a one-time event? Yes, it's a one-time event. All right, we're not going to change our standard. Okay. What about the quantity variance? Why do we order too much? They won't do it in 50-pound increments. They only do it in 100-pound increments. So we had to buy 1,800 pounds. We didn't have a choice. So anytime we want to buy, we have to buy this 50, in these upper 50-pound increments. Maybe we need to change the standard for it because we're going to have some kind of waste in there. Right? Those are the types of decisions that need to be made. And the thing is that now we know exactly where the problems are. We can discuss them and we can take action. But this is really what comes down into that meeting. This is probably one of my favorite slides because remember I told you those 4 people never agree? And it's the truth. So here's what happens in those meetings when we try to figure it out is everybody starts fighting and starts pointing the finger at each other. So you got this guy over here. He's obviously the production manager. He's out there. He says, no, I'm not responsible for this unfavorable material quantity variance. You purchased cheap material. He's talking to the purchasing agent over here. You purchased cheap stuff, so my people had to use more of it. And she says, oh, no, you use too much material because of poorly trained workers. You don't keep your stuff right. You're not taking care of things out there, and you don't even schedule correctly, so I had to rush order material at a higher price, causing unfavorable price variances. Who's right? I don't know. We need to investigate a little bit more, but this is what happens in these meetings. People start pointing the finger and blaming each other for what's going on, and it really can kind of become an issue. And the accountant is usually the one that tries to keep the peace between all of that. It becomes kind of interesting. Let's look at what happens in labor cost variances. The same type of thing. We call them differently, right? Rate variance and efficiency variance. Well, what's the rate? The rate's the price. What's the efficiency? Efficiency is the units. It's the quantity. It's the time. Right? So it's the same thing. We're looking at the same kind of differences. The actual price minus the budgeted price. The actual time minus the budgeted time, and it still gives us the same type of information. Let's look at the example. It says during May, GMAX produced 3,500 club heads working 3,400 hours. Okay, I already see a problem. Didn't it take 1 hour per unit? So it looks like we spent less time. That sounds like a good thing. GMAX paid an average of $8.30 per hour for the hours worked. I think that's wrong because we were only supposed to spend $8 per hour, but maybe since he saved 100 hours and spent 30 cents more per, we'll have to see what's going on there, right? Maybe something happened. So here's how it all shakes out. If we look at the price variance or the rate variance, it's 1,020 unfavorable because of this 30 cents. But then if we look at the time, remember he saved 100 hours in there? Yeah, but it's only 800 favorable, right? So we have an unfavorable price variance and we have a favorable quantity variance, but that nets out still to be an unfavorable cost variance of $220. But now we know where the problems lie. You spent 30 cents too much per hour. Why? You saved 100 hours. How did you do that? And can we replicate that? Can we bring the price back down to 8 and still save 100 hours? In there. So here's one possible explanation of the variance is the use of workers with different skill levels. Usually the higher the skill, the more you have to pay. The lower the skilled worker, the lower you have to pay. So typically using highly paid skilled workers will result in less hours used, right? Fewer labor hours might be required for the work, resulting in a favorable efficiency variance. So there, you have to strike a balance there. The production manager might have been trying to do something well here by hiring more skilled labor at 30 cents more an hour to save time. It didn't work out that way. Let's see who's going to point the finger at who, though, because I'm sure it's still going to happen. This one is probably even more interesting. He says, I'm not responsible for the unfavorable labor efficiency variance. You purchased cheap material, so it took more time to process it. And she said, no, you used too much time because of poorly trained workers and poor supervision. Well, that's when we step in and we say, you're both idiots. You're both absolutely wrong. We look at him and we say, hey, dummy, you didn't use more time. You actually used less. You had a favorable labor efficiency variance. You used less time, so that was good. Your argument is invalid. And then we look over at her and say, no, it isn't because he had poorly trained workers. He actually hired more highly skilled workers to do it. Maybe there's a poor supervision piece in there, but it's going to take more investigation. But why don't the two of you just stop pointing fingers at each other and let's try to figure out how to fix this thing. All right, so finally we get into the overhead standards and variances. We did direct material, we did direct labor. We have to deal with overhead. Just as a reminder, that predetermined overhead rate is calculated by taking estimated total overhead cost divided by estimated activity. Remember, all actual overhead goes into a bucket, but then we use the standard rate to pull money out of the bucket and apply it to our jobs. How do we budget for that? And that's what gets kind of a little bit weird in here. But we are going to take, in order to assign overhead in our budget, we're going to take that predetermined overhead rate and we're going to multiply it by our standard activity. And in most cases, that's going to be by direct labor hours. So when we set our overhead standards, we're going to allocate overhead cost to product services management. We have to do that cost rate. Remember, it is a function of an activity level, such as direct labor hours. And remember that it always has a fixed piece and it always has a variable piece. So that's what kind of makes this hard when we're dealing with our standard budget, is that predetermined overhead rate has a fixed component and a variable component. And in order to really do a flexible budget, we have to be able to separate those things out. So it becomes kind of difficult. So what we really have to do is that we have to look at several levels of activity when we're dealing with our flexible budget for overhead. And what we have to do is we just have to say, what's our monthly capacity? Where's our sweet spot in all of this? GMAX has determined that 80% activity level is kind of their sweet spot. It's the place at which they operate the most efficiently. And you'll see that at that sweet spot at 80%, they're going to produce 4,000 units to give us 4,000 in variable cost because it's $1. Right? We're talking about overhead now, just our overhead. The variable cost of overhead per unit is $1. That gives us 4,000. And then we have 4,000 in fixed costs no matter what to give us total factory overhead. And then if at 4,000 units, right? Remember it was $1 per hour or 1 hour per unit. It's 4,000 direct labor hours. Well, if I just do the multiplication at this sweet spot, I get $2 as our predetermined overhead rate per standard direct labor hour. I know that was probably a little bit confusing to you, but you really have to be thinking back to what we were doing when we looked at variable versus absorption costing. And what happened is that we had to split overhead into two pieces, a variable piece and a fixed piece. Remembering then that the predetermined overhead rate has that fixed and that variable piece combined in it. And now that we're trying to flex our budget, we've got to split our overhead rate up into those two component pieces as well. And that's what we're doing here. The part that you're probably struggling with here is, how do we come up with 80%? And it's real simple. It's a guess, right? Management says this is where we think we should be operating. The 80% is the place we should operate. And then we're basically just doing some backwards math to get to that $2. Don't spend a lot of time struggling on this, without a doubt. Okay. So we'll move on with it. And so when standard cost used, company applies overhead to the units using the predetermined rate. The difference between the total overhead cost applied to products and the total overhead cost actually incurred gives us the variance, right? So the difference between total overhead cost applied to products and the total overhead cost actually incurred gives us the variance. How do we figure it out? It's actual overhead incurred minus standard overhead applied. Okay, so here we go again. During May, GMAX produced 3,500 club heads working 3,400 hours, which was good. GMAX budgeted for 4,000 units, remember 80%. Actual variable overhead was $3,650. Actual fixed overhead, though, was going to be $4,000. Remember, that didn't change at all. So let's look at how that works. So we're going to take that actual overhead plus the 4,000 fixed, right? So there's this 3,650 is the variable piece plus the fixed piece minus our standard. The standard was $2 per direct labor hour. So the actual is going to be 7,650. The standard was going to be 7,000. It means that we're unfavorable by 650. You see what I mean? This is kind of tricky, right? When we start to think about this, again, we have to split up that variable and fixed component to figure out what the actual overhead really is and then compare it to the standard. All right, so let's look at the factors that cause this. Again, remember controllable, uncontrollable. There's going to be obviously some different pieces in there. Let's see it. So here was the actual overhead given, right? And here's the overhead applied from the flexible budget. This gave us an unfavorable controllable variance of $150, right? The actual overhead minus the applied overhead. That's our 150. But then we had an overhead volume variance. Controllable variance is dollars, then we had the volume, it's quantity. It's the same thing, price versus quantity. If we take the budgeted fixed overhead at the predicted capacity, right? Our predicted capacity was 80%, and that was 4,000, right? It's actually going to be, fixed is going to be the same no matter what. And then our applied fixed overhead was 3,500 because there was $1 in there. Remember that $1? So that's 500, unfavorable as well. And that feels a little bit weird because if you're saying that the budgeted expense was 4,000, but we only used up 3,500, why isn't this favorable? Because this looks like we spent less than we budgeted to, right? That would normally look like it's favorable. The problem is that we didn't run at capacity. This is our most efficient place, right? It's because it's fixed overhead. We're going to spend $4,000 no matter what, right? We're actually going to spend $4,000 no matter what because it's fixed and because we didn't run at predicted capacity. We really only applied out 3,500. That means we have 500 underapplied in our overhead account that we just now have to eat and push off. If you remember how that works back a few chapters ago, right? If you want this to be favorable, then we need to run at predicted capacity. That is the end of chapter 21.